In this second video, we're going to shift gears, if you will, and we're going to move to now talk about portfolios. And although this sounds somewhat like an investments topic, the idea of building a portfolio is similar to building a corporation, right? You build a company by adding assets, and we need to understand the risks and returns, the benefits of adding things to the company. How will that affect the company's overall return, and how will it affect the risk of the company? So a portfolio is just a collection of assets. We talked briefly, we assume that all investors are rational. That means that they're risk averse. So they're always going to want to choose those things that will have higher returns or similar returns and less risk. Having said that, then, we know that they're probably going to want to invest in portfolios rather than in single assets. And hopefully by the end of this video, you'll understand a little bit more why that is so important. Without thinking about the math, right, there is an old saying, right? You don't want to put all of your eggs in one basket. So diversifying, that is, spreading your assets out over many choices, is better than having your entire investment portfolio in one single asset. So how do we calculate the rate of return on a portfolio? We need to know the returns of each asset that's in the portfolio, and then we need to know the proportion of the money that's invested in that. So here we have the weight of asset 1 multiplied by the return that we expect to get if we buy 1. Add that to the weight of 2 times the return you expect to get into. So we have this summation formula to calculate returns. So the first thing we might want to do is figure out weights, right? So we had a previous example. We bought 200 shares of Microsoft and P&G. The shares were 73.10 and 92.27 respectively. So in the beginning, what are the weights in our portfolio? So if you multiply 200 times these dollar amounts, you would find that in Microsoft we have $14,620, and in P&G it's $18,454. So the total value of our portfolio is $33,074. By the way, this comes from a worksheet. That's the portfolio beta and return worksheet. What this provides is and says, look, we have 44% of our money is in asset A and roughly 56% of it is in B. At the end of the time frame, we know that the price has changed. So if you make that calculation, our portfolio is now bigger, right? It went from 33,000 to 37,000. But one of the things you see is that our investment in P&G has actually gone down. Remember, there was a negative return for P&G. So in the end here, we have 56% of our money is in asset A or Microsoft, and only 43% is invested in P&G. So we know what? That the weights can be calculated fairly easily, but they're not stable because prices change fairly frequently. So how can we calculate the statistics of a portfolio? One of the basic ways that's already provided for you in the standalone risk worksheet is there are boxes above the assets where you can input weights. So if we wanted to put 70% of our money in A and 30% of our money in B, how would that affect, what would that portfolio look like statistically? If you remember, the first line here is the average return. So the average return is going to be somewhere between the two extremes here. So it's 13.75 is average. What is the risk, though? The risk of A was 7.7. The risk of B was 4.1. But the risk of the portfolio is 4.2. Now that's not less than B, but remember 70% of our money is in this higher risk element. So we do have some risk reduction at work here. The coefficient of variation is 0.31. And again, we also have some high and low ranges based on the average and the statistics. So you can see here that this is the 95% range, that this portfolio will be somewhere between 5.5 and 21.9%, and there's a 95% chance that that will happen. What if we did 30-70? Again, how would that affect the return? Again, is going to be in between the two because it's just an average. But now look at the risk. 7.7 is the risk of A. 4.1 is the risk of B. But 0.71 is the risk of the portfolio. We have almost eliminated the risk of this portfolio by combining them in this way. And we have a relatively high return. This is a great example of how diversification can work. We want to find the highest rate of return that we can get, but we always want to keep in mind we want to reduce risks whenever possible. Now, what creates this magic, if you will, is a statistic called correlation. Correlation just measures the relationship between two assets. They can either be positively or negatively related. That is, they can either move together or they can seem to move apart. They could be as high, the term is perfectly positively correlated, would have a correlation of +1, and perfectly negative would be -1. Now, one of the things I want you to keep in mind as we go through this is, what is the correlation between stocks and bonds? Typically, we find that the correlation is negative, or at the very least, it is usually a very low correlation. What about correlations between domestic investments and international investments? These can be all over the board. We can find different international economies that work very closely compared to the United States economy. But we can also find some that work very different than the economy. So knowing correlation can help us make choices in investing. So to reduce overall risk, it's best to diversify by combining or adding to a portfolio assets that have the lowest possible correlation. If they have a low correlation, we'll be able to reduce the riskiness of the overall portfolio. The lower the correlation between returns, the greater the risk reduction that we can get. So we have an example. Now this is another worksheet. It's called the Portfolio Risk and Return Worksheet. Now in this one, the reason we want to use this worksheet is this worksheet has some correlation information that we can add. So for this example, rate of return is 8% for A, 12% for B. Standard deviation is 2.5 for A and 4.7 for B. Now because of the math, I wanted us to incorporate and use variance, because variance is just a little, mathematically is easier to use to do the calculation for returns here. So you want variance to be such that its standard deviation, or its square root, is 2.5. So if you take 2.5% and square it, you get 0.063%. So you would just put a formula here in this box that would be equals 2.5, and then you use the caret here, that little hat, 2, and that would square it. We also have 3 different possible correlations. what if A and B were perfectly positively correlated? The return in the portfolio would be 10%. Variance would be, or the standard deviation would be 3.6, and the coefficient of variation is 0.36. That's if they were perfectly positively correlated. What if the correlation were 0.5? If you notice, nothing happens to returns. The only thing that changes is the riskiness of that return. So in this case, at 0.5, standard deviation falls to 3.1 and coefficient of variation to 0.317. Yeah, what would happen if it was even lower? What if it was negative 0.5? At negative 0.5, standard deviation falls clear to 2.03, and portfolio coefficient is 0.204. So again, this example helps illustrate what happens when when we combine assets that have lower correlations. You get greater opportunities for diversification. Now, the theory that drives this risk-return relationship is something called the capital asset pricing model. This is just a theory that quantifies the relationship between risk and return. In other words, it helps tell us how much additional return you expect by taking on extra risk. So what types of risk are there? The statistic of standard deviation that we calculated earlier is a measure of total risk. But total risk has two parts. Part of that risk is diversifiable, and the other part is non-diversifiable or undiversifiable. Non-diversifiable is stuff that is really, diversifiable risk is stuff that's attributable to firm-specific causes. Could even be industry-specific causes. But these things get eliminated through diversification. It can also be called unsystematic risk, or firm-specific risk, or company-specific risk. The non-diversifiable risk is those things that are attributable to market factors. They cannot be eliminated through diversification. This is also referred to as systematic risk or market risk. So because an investor can create a portfolio of assets that would work to eliminate diversifiable risk, we would assume that they would diversify enough so that that risk, since we want minimal risk, that risk would be eliminated totally. So we assume that most investors are going to create a portfolio that only has market risk, or the undiversifiable stuff, right? So the only relevant risk when you talk about portfolios is market risk, or the non-diversifiable risk. If you're talking about a single asset all by itself, maybe the most important thing to talk about is its standard deviation. So standard deviation is for single assets. Portfolio risk is typically, we want to only talk about market risk. So let's look at this just a wee little bit closer. So total risk has two parts: systematic, unsystematic, market, company specific, non-diversifiable plus diversifiable. The things that cause market risk are things like interest rates and inflation. It affects all companies. All companies are adversely affected by these, so you can't eliminate them by putting them together. But company-specific risks are things like strikes and lawsuits, right? They're only going to affect one or two companies maybe in your portfolio, so you can diversify away those effects by adding things together that don't go on strike or have lawsuits. So the measure of variance for a two-asset portfolio is essentially stated in this formula. Each asset brings some risk, right? Variance or standard deviation measures risk. So this term is the risk that asset A brings. This term is the risk that asset B brings. Now this third term is the impact on risk of the interaction of the assets. Now all of these numbers are positive because they're square roots of these numbers. The only one that might be different is row AB, which is the statistic correlation. If this is +1, this number will be as big as possible. It won't be any bigger because +1 is the largest amount it can be. But what if it's only 0.5? That means the risk of the portfolio has declined because this is a product, and instead of multiplied by 1, this product's all multiplied by 0.5. What if it's 0? This factor, this component of the formula goes away. What if it's -1? Then this piece is a product. They're all positive except for this one that's -1. So this piece will now be a negative number, but it will be the largest negative number it can be. So that large negative number will subtract from these numbers, which could ultimately reduce the variance to a very low number. Right? So again, as we add things together, we're going to find that we get diversification. So in this graph, there was some research done, and they basically created portfolios, and they looked at the risk of assets. And they did this on the New York Stock Exchange. So what they did is they found the average risk of a stock in the New York Stock Exchange, and that number was up here as around 45%. Then they created portfolios. They randomly picked 2 portfolios, made an equal risk portfolio or an equally weighted portfolio, and calculated the average risk of all of these random portfolios. So imagine they did this 3,000 times. So they randomly picked 2 stocks, calculated their weighted, equally weighted portfolio risk, and then they did that 3,000 times randomly and came up with a number. And what they found out, when they added 2 stocks, risk went down. As they added more and more stocks, risk continued to fall. So the thing that's going away, the reason this is going down, is because diversifiable risk is being eliminated. The non-diversifiable, the market risk, is fixed. It doesn't change. So as we decline, see, it gets to a point where adding more stocks does not dramatically decrease the riskiness in a portfolio. So there comes a point where adding more stocks or creating bigger portfolios does nothing to the riskiness of the portfolio. So if you think about the capital asset pricing model, right, it demonstrates that there is a point of diversification where you can't eliminate more risk. As we mentioned earlier, individual assets, you want to use standard deviation because you want to understand the total risk of that asset. But in a portfolio that's well diversified, the statistic you want to use is a statistic called beta. Beta is a measure of market risk. It basically it looks at the degree of change of return of a stock relative to a change in the stock market. So an asset's historical returns are used, used to find the asset's beta coefficient. And this beta coefficient for the entire market equals 1. And all other betas then are measured relative to this value of 1.0. Right? So let's kind of think about how we might interpret this. A beta of 0 would mean that the stock is not affected by the stock market. A beta of 1, we mentioned, basically says that this is the risk measurement, the market risk of the market. So a stock that has a beta of 1 would respond the exact same way as the market. But a beta of 2 means that it is twice as responsive. So it's 2 times riskier than the stock market. A beta of 0.5 means it's only half as responsive to the market. Now, it is possible for betas to be negative, although we just don't find them very often. But what it means is, it is a measurement of response, but it's a response in the opposite direction. So if the beta was negative 0.5, if the stock market went up 10, this beta would go down by 5, or the return would go down by 5. So how can we calculate this? We have a worksheet that's called Portfolio, Beta, and Return. You input values, right? This comes from individual assets. We know what their weights are. Here are the returns, 10% and 16%. And we expect the beta to be 0.8 and 1.25. So the beta of a portfolio is the weighted average of the betas of the assets in the portfolio. So we just multiply 56% times 0.8 plus 43% times 1.25. So the beta of this portfolio is 0.995. If we say that the risk-free rate is 3%, and later we'll talk about where this number comes from, and we say that the average rate of return of the stock market is 11%, if you plug in a beta here of a portfolio of 0.995%, you would expect to earn 10.96%. So the capital asset pricing model says, based on the riskiness of this portfolio, you should expect 10.96%. But look what we earned. We actually earned 12.5%. So this choice of portfolio is outperforming what the theory says it should. So what would that tell you if you could find a portfolio that would beat what theoretically is possible? Would that be a good thing to buy or not? And the answer, of course, is absolutely. So this is a good investment portfolio. It's earning more than what you think it should earn. Now, what happens if the stock market changes? If we put the betas of a portfolio here and the change in the market here, you can see what? For this one, if the stock market goes up 10%, this stock is going to go up 9.95%. Again, it's not quite as sensitive as the stock market is. So again, let's continue on with our discussion here. The capital asset pricing model ultimately creates us a formula for us. This formula is called the security market line. This formula is the risk-free rate of return, which we can proxy as a T-bill rate. Now your textbook says we should use a 3-month T-bill rate. I have a little bit of a problem with that personally. I would rather use a 20-year or the 30-year rate, just because stocks are long-term assets and they're certainly much longer than a T-bill is. The risk premium, that's the rate of return you earn in excess of the risk-free rate if you invest in the average stock in the stock market. So using the beta then, we can identify the exact risk or the risk we expect for a specific stock based on its market risk. So if you look at risk premiums in our textbook, T-bills are 3.8%, so they say the risk premium is 0. Treasury bonds are 5.3. 5.3 minus 3.8 is 1.5. and common stocks 11.4%. The risk premium they're saying is 7.6%. Now, I personally would rather use the 5.3% to get the things that are more time-oriented with each other. So if I were doing this, I would say I would take 11.4 minus 5.3. So that's 6.1% is what I would use as the risk premium. But that's just me, right? We'll follow the textbook with the textbook's examples. So if we found out using the portfolio beta and return worksheet, again, we've invested in a company. Let's say we buy into Berkshire Hathaway, or we're thinking about it. They have a beta of 0.83. The current risk-free rate's 3.8%. According to the textbook here, the average stock market's 11.4. What would you expect to get on this stock? What return would you expect to get? Plugging those numbers in, we would expect to earn about 10.1% on Berkshire Hathaway's Class B shares. Now, you also could use where it says market risk premium. If you don't know the average rate of return on the stock market, for instance, we can always just substitute this market risk premium. We get the same answer. It's just whether you have the data or not to plug this in. If you assume, again, you've been researching a company, right? If you take the beta for your company and plug it in here for beta, risk-free rate 3.8, stock market 11.4, what rate of return would you get for your company? Now in class, we're going to do an example. We're going to put these on the board, and we're going to look at the different companies and the different rates of returns that we've chosen. So we'll talk about that, obviously, when class comes around. So this security market line is a theory, right? Basically, it says, look, if stocks are in equilibrium, stocks should line up on this line. That the return that you expect to get is dependent on their beta. So what happens, you think, if we get something different? And we've already talked about an example of this. We had that portfolio that had a higher rate of return than what security market line said it should be. Anything that shows up here that's above this theoretical line, everything that shows up here is a buy purchase. It's a signal that you should buy. The stock price is too low. It's creating a return that's too high. And of course, vice versa, anything below that is a sell signal. So the challenges with the CAPM is it relies on historical data, which means that obviously from time to time, companies change their variability, and beta, since it's over time, takes some time actually to make changes. So the most recent changes are not always reflected in the beta that we calculate. So we do have to be concerned that this beta is only a rough approximation. The capital asset pricing model also assumes that stock markets are efficient. From what that means essentially is it assumes that the stock market produces prices that are in equilibrium, that they are fair prices. And we know that in this world there's no perfect kind of a price. There's always going to be some variation in what the stock price actually is. So there are some challenges, if you will, to the capital asset pricing model because the world is not perfect, right? Currently, it's the best thing we have to explain the risk-return relationship. So that's the end of this video on risk and return.